Okay, class, we're going to start chapter 6. This is the very first chapter in Intermediate 2, and we are going to just touch briefly on time value of money. Why is that? Because we're going to get into bonds payable and also lease accounting, and the whole crux of that accounting is about time value of money. In accounting, there are a lot of things we record at their fair value versus the historical cost, and the fair value will include time value of money concepts. So let's get started. And I know you've seen time value of money in many of your classes already, so we'll go through this rather quick. Again, time value of money is all about interest. And so if we had $100 invested in the bank today at a 6% interest rate, by the way, interest is always referred to as always a 12-month rate. And if it's a 3-month note payable or note receivable, an 18-month, doesn't matter. The interest rate will be expressed in a 12-month, an annual rate. So keep that in mind as we go throughout this. And so $100 today would be worth $106 at a 6% yield. Let's just talk briefly about, hey, what is interest? Interest is the cost of using someone else's money or the income from someone using your money. And so that is the cost of money, if you will, interest. So in companies, we'll both borrow money from investors or from banks, and therefore we'll have interest cost, interest expenses over the time period that we use that money at an interest rate, a 12-month rate. If we loan money out, that's what banks do, and if you looked at their balance sheets and financial statements, you would see interest revenue is going to be a big piece for them because other companies, other people are using the bank's money. And so the bank will earn interest over the time period that money is being used until it is paid back at an annual interest rate. And that rate can accrue every day or depending on the period, compounding period, which we'll get into here in just a bit. And so simple interest is just the initial investment times the interest rate in a period of time. That's simple interest. Compound interest not only includes the interest on the initial value, but you can earn interest on the interest that you earn. And we'll see some examples of that here in a minute. So here's a simple interest, $1,000 investment, 10% rate, time period 1 year, and the simple interest would be $100. Let's look at compound interest. This is compounded annually. It could be compounded daily, monthly, semi-annually, annually. So the compounding period will be defined in the arrangement between the two parties. But in this case, this one is compounded annually, and so into the first year, there will be interest of $100, $1,000 times 10% $100. But if you go to the second year, because it's compounded annually, there's that $100 will also earn $10. So the interest in the second year is not a simple interest of 100, it's 110. Because we earn interest on the $1,000, the original investment, plus interest on the interest, the $100 that we earned last year. And then finally, if you look at the third year, there's interest on the interest on the interest, and so $121 here. And so if we looked at this, we'll see this in a minute. $1,000 invested now, compounded annually, earning 10% a year, would be worth $1,331 at the end of 3 years. Spoiler alert, we call this $1,000 the present value of that money, and $1,331 will be called the future value of that. Again, interest rates could be compounded annually. That was not what you normally see. Semi-annually, quarterly, or monthly. So look at this. If it's semi-annually, that means it's going to be compounded twice per year. So there'll be interest on the interest for the first 6 months, and then interest on the interest for the second 6 months, but we do take that interest rate, 12-month rate, and we divide it by 2, so it's 6% for each 6-month period. I'll skip by the quarterly. Monthly, 12% divided by 12 months, 1%. And so money would grow faster and have a higher future value the more times that it's compounded. You'll have more interest. So here's an example of $1,000 compounded twice a year or semi-annually. And so there was 5% on the first $1,000. Again, that's 10% is the stated interest rate, the annual interest rate. Divide that by 2 because there's 2 periods in the year. In the first 6 months, 5% times $1,050. And then in the second 6 months, 5% times $1,050, $5,250. So $1,102.50, which is more than the $1,100 we saw in the very first example that was just done on simple interest. So there's another $2.50 you earn additional, and that's just the 5% times that $50 in interest we earned in the first 6 months. So therefore, interest on interest. We call this the effective annual interest rate, even though the stated annual interest rate is 10%. Well, we would earn $102.50, which would equate to an effective annual interest rate of 10.25%. Why is it higher than 10%? Because it was compounded more than just once. It was compounded twice during the year. And so we earn more because we're able to earn interest on interest inside the year. Now, again, we call this the present value, and this is the future value, 1,000. And we have a table here, and I have posted that on campus, that table. But if we look at the table, we say 10% over 3 periods would be worth 1.331 for every dollar. So $1,000 times 1.331 would be $1,331 at the end of 3 years. So we can use this table. We'll see later. I personally hate the tables. I would never use the tables. You'll see with the time value money calculator, this is a lot easier, and I will certainly allow the use of a time value money calculator on the first exam, because I would rather you learn how to use your calculator for that time when you're out in the working world and using this. And so now if we knew the future value, what's the present value of $1,331 received 3 years from now at an interest rate of 10%? I can figure that out too in the present value table. And I got 10%, I got 3 years. Here's my factor, 0.75131. I multiply that times the future value, and voila, I get my $1,000 present value. Now, the difference between a present value and future value is only one thing, and that's interest. And so if we're looking at the future value, we're adding the 3 years of interest. If we're looking at a future value and trying to determine the present value, we're removing that interest. So the present value is always going to be lower than the future value because of interest. I guess if there was 0% interest, which that would, not going to happen, but then $1,000 would be equal to $1,000. But at a 10% rate, $1,000 today is worth $1,331 in 3 years. Now we also can, if we know the future value is 605, and if we can back into, hey, what's the interest rate? And sometimes we're going to want to know that. Is this a good deal for us or not? What is the interest rate? Well, we can take and calculate 605, 500 divided by 605, and so the factor would be 0.82645. We can go search for that, and we know it's 2 periods. We find this is the 0.82645 right here in the table, and interest rate's 10%. So if we know the term, we know the interest rate, and well, let's do it. If we know that there's 4 factors at this point so far: the term, the interest rate, the present value, the future value. So if you know any 3 of those, you can find a 4th. That's just simple algebra. And so here is one where we're trying to solve for n. So we know the present value, we know the future value, we know interest. Now we're trying to solve for how many years would that be. And so we calculate 10,000, present value is of 10,000, 16,000, I'm sorry here, 10,000 divided by the future value of 16, that 0.625, we get close, we can see that n equals 5 there. And so, again, not a big fan of using the tables. You can see how I even get caught up in that math there. And I will also show you how to do that on a present value calculator, which is a lot easier. Now, annuity, we're adding one additional factor. Again, we have 4 factors so far. We have the interest rate, we have the term, the N, we have the present value, PV, and the future value, FV. Those are 4 variables. Now we're going to add a 5th variable, which is a payment. Usually we abbreviate that PMT. And so the payment is related to an ordinary annuity. We also have annuity due. We'll talk about that in a minute. But annuity is an equal stream of cash payments over time that have interest associated with it. What's a great example of that? A mortgage. And so if you get a mortgage from the bank, you're going to pay them monthly payments for, if it's a 30-year mortgage, which is generally the typical mortgage, a 30-year mortgage, there's going to be 360 equal payments, and so a certain amount, and it will be an interest rate. The N is going to be 360, 30 years. And what would the compounding amount be? Because whatever the interest rate would be, we have to divide that by 12 because the compounding period for a monthly mortgage is monthly. Now, ordinary annuity, the cash flows occur at the end of the period, and annuity due, they occur at the beginning of the period. So when we look at bonds in chapter 14, that payment is at the end of the period. And so corporate bonds usually are semi-annual, compounded semi-annually. So interest is paid every 6 months over the life of that bond. And so payment at the end of that first payment at the end of that 6 months is going to have 6 months of interest associated with that. Now, annuity due, payment at the beginning of each period. And one cash flow I'm sure as students you're all familiar with is rent. How do you pay your rent? You pay at the beginning of the month, first of the month. And so when we get to chapter 15, lease accounting, we're going to look at the present value of annuity due, where rent payments are paid at the beginning of each month over the life of that rent. And we're going to calculate the present value of those future lease payments, and we're going to put a liability and an asset on our books. And so again, that's chapter 15. That's why this really matters here and why I'm going through a refresher here. And so an installment note payable might require debtor to make 3 equal annual payments. First payment is due here. So therefore, we can see right off the bat, the first payment is after a year. So that's what we call an ordinary annuity. Unlike this, a lease situation where the payment is made at the beginning of each period, that is what we call an annuity due. Payment at the beginning of each period. So here's 3 $10,000 payments, compounded, let's see, annually, compounded annually here, and it's 10%. And so we can kind of calculate that factor of 3.31. But if you put $10,000 into the bank at the end of each year and a 10% interest, at the end of that you'll have $33,100. Now you only made $30,000 of payments. That would be the payment amount. But guess what? We earned $3,100 of interest. And so that would be the future value at the end of those 3 years. What's the present value? 0. There was no upfront payment with this one. And we can go to, if we go to the right table, this is when you use the tables, there's going to be 6 of these tables. There's going to be the present value of an ordinary annuity, and then the present value of annuity due. And then we're going to have future value without payments, future value of an ordinary annuity, and the future value of an annuity due. So you really want to make sure you're using the right tables. You have to understand how does the cash flows, what's the timing of the cash flows first, so you know which table to get into. But here you go, 10,000 payment at N equals 3, I equals 10%. I can go get my factor, 10% over 3 periods, 3.31, $3.31 for every $1. We have $10,000 times 3.31, $33,100 is the future value of that annuity payment of $10,000 at the end of each period. Now, here's the present value of an annuity due. The payments are made up front. In this case, it's a larger factor because those payments are made up front, so there's going to be interest accrued, for a longer time period. And again, same thing. We can go pull out the future value of the annuity due, 3.641, and we can calculate $36,410. So we can also come back and look at the present value of an annuity. This is a ordinary present value of annuity due, first payment, second payment, third payment. And so the present value, we're going to remove the interest out of that. And so the present value, that would be $27,355. And so if we received, so we're kind of neutral to receive $27,355 right up front, or 3 payments of $10,000 at the beginning of each month, or receive nothing for 3 years and then just receive $36,410. So you can see how business decisions are going to be made based on understanding the time value of money. Again, present value of an annuity due, we use the present value of annuity due table. We can pull up that factor, 2.7355, and that's where we get it from the table where N equals 3 and interest equals 10%. We'll pull up that factor, multiply, that's the factor for each $1, multiply it times $10,000, and we understand that the present value is $27,355. And we can have more complicated things where there's 3 $10,000 payments out in the future, but we got 2 periods with no payments, and so we will have to understand math like that. If you think about chapter 16, pensions, people work at a company for 30 years or more or less, and then they receive payments when they start at 65 until they die. And so that would how we would calculate the present value of future pension payments, because we have payments out here. And so in reality, you could come back here and do the present value here of an annuity, ordinary annuity, and then take that number, present value for 2 years back to day 1, and you can calculate that amount. Now, we're going to use calculators in this class, and so again, there's 5 variables: N, percent interest, present value, future value, payment. I would say there's a 6th variable, is if there is a payment, is it paid at the beginning of the period or the end of the period? So I'm going to pull up the visualizer here and show you with my own calculator how to do that. Let's take a simple one first. Let's say $1,000 today, 10% interest. Oh. I gotta put that on the right screen. Here we go. Let's say we had $1,000 today, 10% interest, and let's say, let's make it interesting, 5 years. So if we had $1,000 put in the bank, and let's just compound it annually to make it easy. And so what would that end up being at the end of 5 years? And again, no annuity here, so no payments. This is just a easy one here. One thing with your calculator, you have to always make sure you do, clear everything out, because it will remember old numbers that are just sitting there. And so you'll have to figure out your own calculator. I love the HP 12C, so I'm turn it on, clear everything out. I got $1,000 here, and that's the present value. That's the day one value. And I got my interest rate of 10%, 5 years in, payments equal to 0. What's the future value? $1,610. So future value. To see how simple that is, let's do let's look at a mortgage. So term of the mortgage, let's call it 30 years. Compounded monthly, and let's say there were 12 payments per year, or it's paid monthly payments. Let's say the interest rate, let's call it 6%. I think mortgages are a lot less than that today, but let's call it 6%. And the let's call the present value, let's borrow $300,000. That's kind of a bit of an average house price these days. So again, NI, present value, future value, payment. And then beginning or ending. This is going to be, mortgages are paid at the end, so this is an ordinary annuity, not an annuity due. And so in 30 years times 12, there's going to be 360 payments. 30 years times 12 payments per year, paid monthly. Interest rate 6% divided by 12. That's very important here because this is a payment every single month. So that's going to be 0.5%. Present value is $300,000. Future value is 0, but at the end of the mortgage, we will not owe anything. And so you can see, as long as I know 4 of the 5 variables, I can calculate the 5th variable. So let's go do that. Again, you can use a time value of money table, and you can learn how to do that, or you can learn how to use your calculator. I'd rather you learn how to do your calculator. So let's clear everything out, and I've got 360 press the N, 0.5% interest, and then 300,000. Don't clear that out. 300,000 equals the present value, and then calculate the payment of that. 1798.65. Let's look at that in reverse. Let's just say, hey, if I was going to pay 1798 points, there's probably some rounding here, for 360 months, 30 years. How much is that worth today? So if I'm willing, so you might want to say, hey, I can afford an $1,800 payment. So what kind of house, what kind of mortgage can I get? So we're going to back into it. So N is still 360 in this case. I is still equal 6% divided by 12, 0.5%. Present value, I don't know. Future value equals 0. And what else we need? Oh, payment. Payment is going to equal 1798.65. So let's pull out the trusted calculator here. And so we're going to see, it'll be interesting to see if we get 300,000 here. There may be some rounding involved, so I'm going to clear everything out. And so in this case, N 360.5 is the interest rate. The payment, 1798.65 payment. What's the present value? 299,999. So 0.74, rounding that 300,000. And so you can see, as long as I know 4 of the 5 variables, I can calculate the last variable. So hopefully that makes sense for you. Let's do an annuity due here also, which is the payment at the beginning of the period. Let's say a company is going to rent a place for $10,000 a month. Per month, and they're going to rent it term equals 10 years, and the interest rate, which we'll see when we get to chapter 15 how we look at that interest rate, let's call it 3%. Well, we'll do 12%. I know interest rates are a lot lower these days, but they were 12% at one time. And so that's our rent. So we want to know what's the present value of all these future rent payments, and we're going to go record an asset and a liability on our books for leases, and that's chapter 15. So again, let's look at our factors. N equals 10 years times 12. In other words, we're going to make 120 payments. I equals 12%. That's a 12-month rate, so we have to divide that by 12. 1% for each month. And then the present value, that's what we're trying to solve for. Future value equals 0, because we'll be out of it in the future. And then finally, we've got our N, I, and our payment. Payment going to equal to 10,000. So what's the present value of all of that? Let's go calculate. So clear everything out. Now here's the problem. This is annuity due, because rent are paid up front. So I have to go into my calculator, and your calculator may be different in this, but this here is the begin mode. I'm automatically in the end mode, but I got to switch this using this green button for mine, and look at that. Now, I'm in the begin mode. And when you get to the exam, you have to remember to change this. If you're in the end mode doing bonds, you have a lease problem, you got to switch it over to that begin mode for leases. I see a lot of people in the exam who miss this. So I'm in the begin mode, and now I just do my math, clear everything out. 120 is my N. 1% is my interest rate. Future value is equal 0. 10,000 equals my payment and a begin mode, and then what's PV? 703,000. 703 970 975. So 703 975. We're going to work some time value of money problems here, and you may want to go through that. I will note that another way to do it is go memorize all these formulas here, because those are the mathematical formulas for present value and future value. Again, don't even think about it. That is not the right way to go. You can use the time value money tables. They're posted on Canvas, and I'll let you a lot of information in the textbook about how to use the time value money tables, and you can print those out for the exam. But I would highly recommend you figure out how to use a time value money calculator. That will work better for you. And I'll just tell you a story really quickly and to end this up. I remember when I was, I think I was a manager of financial planning analysis in Indianapolis, and I wanted to buy a Camaro. My son He likes Camaros now. I'm not big into Camaros anymore. I'm more conservative, I guess. But I went down to the local car dealership, and the guy had a beautiful Camaro. It was dark green, but it was they had just changed the model. It was a gorgeous car, and I was ready to buy it. And I test drove it. I was ready to buy it. We sat down, and guess what? As a finance accounting guy, I brought my time value money calculator in there, and he was telling me the lease amounts. I don't remember what they were. It was like a 4-year lease, something. Da, 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 da. I said, what? That's a 15% interest. And he was like, no, don't worry about it. It's just $1,000 a month. You can handle it. I said, it's 15% interest. I'm not going to do that. I said, well, let me go talk to him. I said, forget about it. And I walked out of the place. So understanding time value money is going to help you in your personal life as you make decisions. And as you make decisions in your personal life, it's the same thing for companies. They're going to make decisions where they want higher levels of return when people are using their money, and when they're borrowing money, they want low interest rates, right? And so just as we would as individuals make decisions, companies are also going to use time value money to make decisions. And at the same time, here in this course, we are going to have to calculate the fair value, the market value of a bond based on future payment streams. We're going to have to understand the present value of our future lease payments to put a lease obligation on our books. So this topic is really going to matter for you, especially in the first module of this course. Thank you, guys.